Why is it that many of us Africans work so hard, and yet when it comes to building wealth, our money seems to be so fragile? You might have already seen this happen. You get a promotion, your business is doing well, your income is increasing, and then all of a sudden, one family emergency and your income drops down to zero. The truth of the matter is that many of us Africans invest without following fundamental money rules that are meant to ensure our money is safeguarded. In today's video, I'm going to share 4 key rules that are going to help you to build sustainable wealth right here in Africa. But before we get started, if you are not a subscriber to my channel already, subscribe to my channel by clicking the subscribe button. You'll find it at the bottom. It's down here. Click subscribe right now. Let's get started. Rule number 1, the survival test. Before your money is able to grow, it needs to be able to survive. In our environment, emergencies aren't rare. They are a daily occurrence. Whether it's an unexpected hospital bill, a sudden death in the family, or you lose a job, the pressure on your money is instant. If one crisis forces you to sell your investments in shares, to sell your land at a loss, or to borrow money at an interest rate of 30%, then you're gambling with your money. It is never going to grow. So before you can put your naira, your shillings, your rand, or even your kwacha into any investment, you need to ensure that your money can survive any shock. So your focus should not be on investing if you are not able to manage your emergencies. Your focus should be on ensuring that your money can survive any shocks by building an emergency fund. This is a fundamental money rule that many of us ignore. Rather, we jump right into investing and then are faced with emergencies, and quickly we want to liquidate our investments so as to manage our emergencies. If you are in this scenario, ensure that your money is able to survive shocks first before it can start growing. Rule number 2, the privacy of wealth. You may have heard this saying, money doesn't like noise. What normally happens in many African societies is that when you are doing well, you start making some money. All of a sudden, there's pressure to increase your lifestyle. What many of us fail to understand is that if your lifestyle increases faster than your living expenses, then your money is going to be compounding at a very small pace. And yes, I understand the pressure to show society that you are actually doing well, because many Africans expect you, if you are making money, to have a certain persona. However, many people that build wealth world over understand that money should not be loud. It should be built in privacy. People are not supposed to know how much money you've built up so far, because that attracts a lot of interest. You might be receiving interest from family members because all of a sudden they know that you are doing really well and you are making money, and they start asking you for commitments, contributions, and just ensuring that you are able to support their livelihoods as well at the same time as your own. Now, don't get me wrong here. I'm not saying don't support your family members, but what normally happens when your lifestyle is exposed and you start showing people that you're actually making money, you start attracting attention, and people expect you to start helping them as well, even when you have not yet established that stable base for you to start compounding your money. And in fact, the other attraction that you get is from the tax authorities, because you are exposing yourself. Even the tax authorities in many countries are interested in your activities. Before you can even build sustainable wealth, your money starts plummeting because you've attracted the wrong interest. So remember, money likes privacy. Build it in a quiet way. Don't be loud. And that's a mistake many of us make. Rule number 3, the real return. You've seen the headlines. This investment fund is able to earn you a return of 15%. This government bond is able to earn you coupon incomes or yields of 20% per annum. This property will be able to make you more than 50% return. So many headlines when it comes to returns on investment. But what you don't get to see is the context in which these returns are supposed to be yielded. If the return that is being shown to you is a nominal return, which does not take into account inflation, because in Africa, inflation moves, interest rates move, expenses move. So the kind of return you're supposed to be talking about is the real return, not a nominal return. Nominal return does not take into account inflation rate. So the 15% return on an investment fund that people might be talking about may have not taken into account the 18% current inflation rate. And what that simply means is that you are actually losing money, because 15 minus 18 is a negative. And that means that your money does not have sufficient purchasing power. Your target, your strategy should be about making investments that earn you returns that beat the inflation rate, so that you are earning real returns that are positive and that are consistent and that sustain the purchasing power of your money 1 year, 2 years, or even 5 years later. So when you see the headlines in terms of the returns on investments, always consider the context. What is the current inflation rate? If your return or profit doesn't beat the inflation rate, you are not building wealth. You're simply trending waters. Rule number 4, consistency over intelligence. In Africa, we value intelligence more than anything. That's why you see many of us Africans are overeducated. We focus on PhDs, master's degrees, and all these qualifications. But when it comes to building wealth, it's about consistency and not intelligence. African markets, particularly capital markets, are pretty slow. Many people might not see the returns as quickly as they want. And they may think that they need to jump over to other investments. That is a mistake. That's why in Africa, patience is a competitive advantage that if you have, will enable you to compound your money. Because compounding is not about how smart you are. It is about how consistent you are and how long you stay within the market. That is the only time you get to see your money compounded over a period of time. Those who stay in the market and strategically invest their money in different asset portfolios or classes are the ones who are going to benefit from compounding in the long term. So patience is a true competitive advantage. Building wealth in Africa might seem very hard. However, if you follow these 4 key fundamental money rules, you are going to start building sustainable wealth. Remember, you need to ensure you build resiliency so that you can withstand any shocks in your income. So don't invest your money if you know that your money cannot survive any shocks. The second rule, money doesn't like noise. Build your wealth in privacy so that you don't attract unnecessary attention before your money can start compounding. Thirdly, you need to understand the context so that your money has real purchasing power. Finally, consistency. Ensure that you're able to stay in the market for a long period of time so that time can do the heavy lifting on your behalf. Which of these money rules have you been breaking? I would love to hear from you in the comment section below. Comment either 1, 2, 3, or 4 in the comment section below and let me know which money rule you've been breaking. I do hope these insights are going to help you to start operating in a different way when it comes to managing your money. Thank you so much for watching. If you haven't subscribed already, subscribe to my channel by clicking the subscribe button. You'll find it at the top. It is up here. Click subscribe right now. See you next time.